This is the Alternative Investing Advantage podcast from Advanta IRA, where we show you how to explore investments beyond Wall Street and open your eyes to new options for your portfolio. It's time to take control and give yourself the freedom to choose where you invest your money.
Hi, and welcome to another edition of the Alternative Investing Advantage podcast. My name is Alex Perny, and today we're going to be digging in to Roth conversions. So we're going to be doing a little bit of a double time on Roth conversions this week, as I will be doing a slightly longer, more in-depth format review of them on our webinar this week. But I feel it's a very important topic to hit. And we also have a couple different fantastic interviews coming up next week with a few things that were kind of edging into a few topics that I wanted to cover this week. So I think it's a great topic to kind of cover twice to get a little bit of a different viewpoint on this podcast to kind of show a few different aspects that we may not necessarily get to in the in our webinar. So again, something definitely great to stick around for with some good content on Roth conversions. But today on the download, we have some really interesting news coming out of the markets. Big news between crypto giants FTX and Binance, two of the largest players in the cryptocurrency exchange world. Now, for people not necessarily so familiar with this, what's been going on essentially is that the two owners of these two companies have kind of been going back and forth on social media and Twitter and having a little bit of a rather pointed social media battle about different things going on with the companies, potential buyouts, and the like. But what we've seen in recent days is a huge amount of liquidity issues with FTX being able to actually cover the trades and the withdrawals of their investors, and has seen the net worth of the owner of FTX plummet an approximate $14 billion in about 10 or 15 days. So that has just been absolutely wild to see. And so far, a letter of intent, or at least an informal letter of intent, has been issued by Binance to actually purchase FTX and to bring them into the fold to help with the liquidity issues, and also will position Binance to be one of the largest cryptocurrency exchanges in the world, right up there with Coinbase, Kraken, and Gemini. So definitely some interesting news to watch coming out of this rather interesting, almost soap opera like back and forth, soap opera like exchanges that have been coming out of this. These two companies. So again, something to watch. It is still rather tenuous, to say the best, when it comes to investing in cryptocurrencies at the moment. It is still all over the place, and the dust has not settled by any stretch of the imagination when it comes to pricing on any of the large cryptocurrencies. Almost all of them are down half, if not more, of their initial value from the beginning of the year. So now might be a good time to look at investing potentially. And then it also plays into something that might be good to look into if you are invested in cryptocurrencies, especially with IRAs, as to some things with Roth conversions. And we'll get into that a little bit later. Sticking with the theme of tech, Meta Facebook is set to start layoffs for the first time since the company was founded in 2004. This is coming on the heels of heavy losses in the digital advertising space, as well as the very large and very expensive play that CEO Mark Zuckerberg made in the push for what was dubbed the metaverse, his augmented and alternate reality of sorts, where people would actually buy digital real estate and interact in a fully digital way. Now, is this something that might come out and kind of be more popular in the future? Who's to say? Personally, I found it a little odd with how much of a push was being made for the metaverse, and personally, I kind of saw this being a little bit of a tilting at windmills, if you will, to look back at some classical literature in Don Quixote. But it's definitely something to look at as very rather frightening for a company that has been so steadfast in its hiring and its growth that for almost the past 18 years that it has been able to continually grow and continually hire, and now it's looking at actually having to lay off a portion of its workforce is it's sad and frightening. We definitely feel for the people that are going to be affected by these layoffs, and Facebook has indicated that they will not be doing any hiring until at least late 2023. So this is not something that is just going to be in the short term. They are putting off hiring and even firing people well into next year, and this is across several different platforms. Snap, which is the company which owns and controls Snapchat, has also indicated that they are looking to lay off about 20 to 30% of their workforce as well. So social media just absolutely getting crushed right now with different aspects of the pullback on digital advertising. And we'll get into some of the other social media platforms here in a moment as well. Elon Musk just sold about 19.5 million shares of Tesla to raise about $4 billion to help finance the portion of his purchase of Twitter. Now, the specifics of this deal aren't actually fully public. We do know that portions of the actual purchase were financed by different Wall Street banks. There were some private investors and also Elon Musk coming in to the fold to actually finance a portion of it personally. Now, this large tranche and sell-off of Twitter did cause, or of Tesla did cause a slight dip in the share price, but he is still by far and away the majority owner of Tesla on the publicly exchanged markets. And it's just going to, essentially kind of look at this to float the actual purchase of the purchase of Twitter. Now, Twitter also looking at rather large layoffs again with the pullback of digital advertisers, especially in the wake of Elon Musk purchasing the company. It is still early to say, and since it now is a private company, there's much less disclosure that has to be done. But it's preliminary reports showing that there might be at least a 25% to a 40% reduction in workforce at Twitter as well. So looking at just how bad it is getting in the social media and digital advertising markets is rather frightening, but it will be something to kind of watch with a keen eye, because that might be showing a shift in markets of where people are actually advertising, how people are consuming content, and the like. So when you do see a pullback in one area, it doesn't necessarily mean that, hey, this is going to be, just something bad to be avoided. We're definitely going to see some opportunities for investment in other areas, but we're just going to need to kind of keep a keen eye and see where exactly those are going to be. Now, unfortunately, with regard to most of the markets, they're taking kind of a beating right now as we just had the midterm elections yesterday. Now, many of the races are still being counted, and we'll wait for the dust to settle on that. We're not going to necessarily get into opinions and thoughts on who won or who lost, but it is always good to watch markets whenever we do have midterm elections, as they typically always take a little bit of a dip, which can be, again, a little bit of a benefit to the investor and cause some opportunities, but it's also a storm that's worth weathering. The midterm elections have seen a rather seesaw effect of almost all of the stock market indexes, such as the NASDAQ, S&P 500, and the like. Most all of them had dips in the morning, raised in the evenings of Tuesday, November 8th, and also Monday as well. Just a lot of uncertainty with things going on. So expect everything to stabilize rather well towards the end of the week. Again, it will be kind of, a bit early to tell as to what exactly will kind of flesh out with everything. But again, it's something to kind of watch. Hopefully this will kind of get back and behind us rather quickly. But most of the time when people are looking around this time of year of midterm elections, that's a lot of what's causing the markets to shift artificially, is just the uncertainty surrounding the elections. Now, some actual good news right now. We are seeing energy prices stabilize a bit, as Vietnam, of all people, has announced that they are going to be ramping up gas and energy production in the response to OPEC deciding to cut production. So kind of a new player in the realm of being able to affect global energy prices, but definitely something good to see is that another country besides someone like the United States or a Eastern Europe or a Western European nation taking up the slack when we've seen OPEC adjust their production numbers. And that's in no way a reflection on, sentiments towards that. It's just an interesting thing to see new players coming into a market to help adjust when there's other when there's other forces at play. No different than, let's say if manufacturing of some good was cut in some region and then it picks up in another region, just kind of the perspective that I'm taking on that. So it'll be interesting to see how much of the global demand that Vietnam can kind of absorb and what it actually does for their economy as well. Because if they're going to be picking up production and ramping up the sale of energy and gas and oil products, it'll definitely be interesting to see how it kind of flushes out and plays into their general economy. So hopefully that kind of helps everyone that is being affected by the ongoing energy, and I hesitate to say crisis, but issues that are occurring in the world with the ongoing conflict in Russia and Ukraine, OPEC cutting production, reserves being dipped into in the United States. So seeing an increase in production from a country that can hopefully, meet some of the demand of the world, definitely be interesting to see. But that's what we have today on the download. Now, today on the what is net asset value, or NAV? Net asset value is the net value of an investment fund's assets less its liabilities, divided by the number of shares outstanding. Most commonly used in the context of a mutual fund or an exchange traded fund, NAV is the price at which shares of the fund registered in the U.S. Securities Exchange Commission are traded. So to understand net asset value, for companies and business entities, the difference between the assets and the liabilities is known as the net assets or net worth of the capital of the company. The fund's NAV represents a per share value of the fund, which makes it easier to be used for valuing the transacted fund shares. NAV is often close or equal to the book value of a business. Companies considered to have a high growth prospects are traditionally valued more than the NAV might suggest. NAV is most frequently used to compare market capitalization to find undervalued or overvalued investments. This is the NAV, and this has been the What Is. All right, so what I really want to talk to people about today is Roth conversions. Now, what exactly is a Roth conversion? A Roth conversion, in its most simplest term, is moving funds from a pre-tax source, such as a pre-tax 401k, a simple IRA, a SEP IRA, a traditional IRA, and moving those assets into an after-tax plan, such as a Roth IRA. This can also be done with a Roth 401k, and there's some other different, let's call it fine points to look at with that. But in general, it is the hedge that you would like to go ahead and pay taxes now on whatever your investments are. So that way, when you go to withdraw the assets from your plan in the future, that you will have to pay zero taxes in the future. Now, there's a lot of different reasons why people might elect to do a Roth conversion. A lot of people, and I think that I would count myself among them, think that paying no tax on something is better than paying some tax on something, but it's not always that simple. To get that inherent great benefit of a Roth IRA distribution of paying no tax on any of the distribution, you have to jump through a few hoops. Now, let's look at inherently what makes a Roth IRA great. You go ahead and you pay the tax on whatever's going into it at your current tax rate. Now, this is good for a number of reasons. Typically, as people get older, they make more money, your tax rate goes up. Also, traditionally, if you look at a graph of tax in the United States, it, sits on a relatively steady increase of going up over time. Now, obviously, you have to adjust that for looking at what different inflation is and what your true cost of living in goods are at a certain given time to say, okay, well, here's what my effective tax rate would be. But most of the time, taxes tend to generally go up. So the thought is that if you go ahead and pay the taxes now on something, and then you continually compound the earnings tax exempt within a particular retirement plan, that in retirement you'll have a much better shake and essentially get to take home more money at the end of the day, because remember, it's not what you make, it's what you keep. So the Roth IRA becomes a very attractive option. Again, also with being able to say that you're taking money out of a retirement plan and getting to pay absolutely zero taxes is a pretty nice prospect for a lot of people. but you can't necessarily just go ahead and dump as much money as you want to in a Roth IRA. You're limited to $6,500 or $7,500 per year, according to IRS updates that have just come out. So you got a little bit of a bump coming into next year, but currently you have $6,000 or $7,000, or $6,500 and $7,500, depending on your age in 2023. It's not a whole lot of money going in there at one time. Now, a lot of people say, well, I have a lot of money plugged away into a 401k, and that's where a lot of people initially fund IRAs from, is from old 401ks. Well, 401ks have also limiting factors of how much money you can put in a given year. You're limited to $20,500 or $26,500, depending on your age of deferrals or how much money is matched into that. Let's just say that you're not necessarily getting to write a check. Go ahead and do it after tax into any given plan, as much money as you'd like to in a given year. But let's say you've accrued funds over a certain given amount of time, and you've been making those contributions pre-tax into whatever plans that you're in. And you're in, let's say, a traditional IRA, a SEP IRA, and you've made some investments. And especially over the past year, you've seen values fluctuate. I would say that almost anyone that's bought anything over the past year has seen some type of dip or fluctuation in pricing. And illustrating the benefit of being able to do a Roth conversion is, I think, a very good thing to look at, especially with the current market climate that we're in. So what exactly is a Roth conversion? It means that you're going to say, okay, now is a beneficial time for me, for one reason or another, to take cash or assets from a pre-tax plan. So remember, 401k, traditional IRA, SEP IRA, simple IRA, move it to a Roth IRA. So change the status from pre to post tax, and then pay the tax on the value of whatever I converted. Now, it's easy enough to say, if you're looking at something that is cash or a cash equivalent, to say, okay, let's say I convert $10,000 from my traditional IRA of cash, or $10,000 of publicly traded securities. I'm going to have an additional, I'm essentially claiming in $10,000 of additional income to my personal income tax statement to pay tax on that year. That's relatively easy to see how that works. So let's say, again, I convert $10,000 of cash from my traditional IRA to my Roth IRA. Then at the end of the year, I have a 1099 showing that I had an additional $10,000 of income. I pay tax on that. And then going forward, that money that I moved from the pre to post tax, so traditional to Roth, is now considered Roth IRA funds. And going forward, any earnings that are associated with that accrue after tax. And then I also don't have to pay any tax when I pay distributions in retirement. So that's really easy to look at. But a lot of people, especially people that are invested in alternative assets, just don't sit around with cash on hand and looking at this saying, okay, great, it's easy to look at cash, but what if I'm invested in something? What if I'm investing into some type of private LLC, or if I'm invested into a limited partnership or a piece of real estate? What does that look like? There's a lot of different factors that need to be looked at with that, and rightfully so. Yes, there are, and some potentially big benefits and maybe some drawbacks to trying to do Roth conversions, especially towards the end of the year. So let's look at some of the specific rules regarding Roth conversions. Anyone can do a Roth conversion. There was some legislation that had come up a few years ago that was going to try to limit the individual earners. So saying if you earned over a certain amount, you could not do a Roth conversion. That is not the case. Doesn't matter how much money you make, or if you made zero money in a given year, anyone can do a Roth conversion. You are not phased out of ever being able to do a Roth conversion. You do not have to convert the entirety of your pre-tax basis or the entirety of any one given asset from pre to post-tax, going from traditional to Roth. You do not have to convert the entire amount if you do not want to. You can do these in chunks, and you can also do it over multiple years. Also, keep in mind that if you are of an older age and you have required minimum distributions, you have crossed into a year when you have to take a required minimum distribution, a required minimum distribution cannot be converted into a Roth IRA. So Roth IRAs do not have required minimum distribution, which is also a benefit of why people might choose to try to get money into Roth IRAs. But if you have a required minimum distribution, you cannot say, you know what, instead of taking that distribution out personally, paying tax on it, I'm going to do a Roth conversion and pay tax on it. You have to withdraw those funds from that plan. You cannot just say, well, I'm doing a Roth conversion. If you've crossed into a year and you are obligated to take a required minimum distribution, you have to do it. You cannot just treat it as a Roth conversion. So, with some of the basis of the rules laid out, let's look at what different types of assets might look like when it comes to actually doing a Roth conversion. Now, the nice thing about a Roth conversion, it is done at a point in time value. So, if you're looking at something and you're saying, you know what, I'm invested in X and I want to do a Roth conversion, well, you don't do it at the original purchase price. Now, this can be good or bad. Let's say you want to do a Roth conversion and the assets that you have absolutely skyrocketed in value. Well, that's great for you, but it can be bad from the position of looking at doing a Roth conversion, because if you had bought, let's say, an asset for $100,000 and you wanted to convert it and it is now worth $400,000. Well, if you wanted to convert the whole thing, you're going to have to pay, you're going to have to get it valued. And we'll get into that in a moment of some of the procedural issues of doing a Roth conversion. Well, you would have to pay tax on $400,000 as opposed to the $100,000 of basis that you originally purchased it for. Unfortunately, basis and underlying purchase price don't really have anything to do with doing conversions from pre to post tax like they would outside of an IRA if you were doing some maybe different financing things. So what you're looking at is simply a snapshot of market value at a given point in time is what you're going to be converting, because valuations are good for 30 days when it comes to doing a conversion of any type of asset within an IRA. So in that scenario, you bought something for 400, you bought something for 100,000, it's worth 400. If you want to convert that asset, and let's say it's a piece of real estate, we use real estate in this example because that's what a lot of alternative investors that at least we handle deal with. So let's say you had that, again, that $400,000 piece of real estate. You get a certified appraisal, and there would need to be a quick claim deed done, moving it from the traditional to the Roth, and then you would get a 1099 for 400 grand. Well, that's a lot to stomach, and unless you had a lot of losses or a lot of something that's going to offset that, paying tax on $400,000 of additional income for almost anyone, you're going to have a lot of earnings to potentially try to offset that huge tax liability that you would have personally. Now, how do you try to mitigate that? Well, there's a few different ways to look at it. One, you don't have to do the entirety of that asset as a Roth conversion. A lot of people will, especially towards the end of the year, try to do some tax forecasting, say, hey, how much money do I have left in my next tax bracket? Let me convert only a certain amount of that up into my next tax bracket so I don't pay more taxes than I need to, or maybe I have some credits and offsets that would help to absorb some more income. So I'm only just going to do a portion of the actual asset, the total asset. So I'm going to convert maybe 20 or 30% of it. And then maybe do one in a following year. Or maybe you have some plans to carry forward some different tax planning strategies into a following year, but you want to have the entirety of the asset for one reason or another held within that Roth IRA. Because if you do a partial, you're going to have it in two different accounts. Well, what some people would do is they'd look towards the end of the year and say, you know what? Because Roth conversions are based on a tax calendar year of January 1 to December 31, why don't I do the conversion do part of the conversion at the last week of December, do the other portion in the first week of January, thereby bifurcating my tax liability over 2 years, but effectively accomplishing the conversion in its entirety in the same amount of time as I otherwise would have. So that's an effective strategy a lot of people like to utilize at the end of a year to do a full conversion while splitting their tax liability over multiple years. Now, you could do this again and stretch it out. You don't have to, again, do the entirety of the conversion in that kind of last little window of the year. You can split it up however you'd like to, but just keep in mind that Roth conversions are going to be calculated in the specific year that in which you do them. So you don't necessarily need to look past that. It's going to be whatever year that it's done in, and that is defined as whatever year it's specifically that you actually do the transaction. So if the transaction falls within a 2022 date, then it's counted on your 2022 taxes. If it's counted on a 23 date, it's going to be next year's taxes. And again, you can't predate these. It has to be done. You can't pre or post date them. So they have to be done as of a certain date, and you have to fall within those windows. So real estate, again, kind of an easy one to look at, but there's a lot of other different assets out there, and some of them are going to be harder to value than others. You can't necessarily just say to the IRA custodian, hey, the value of this is X. And sometimes you would have to get a third party to come in and levy some type of, quote, certified valuation. Now, what is a certified valuation, especially if we're talking about things like private stock or limited partnerships, investments in commercial real estate? all these different types of, let's say, harder to value assets. Well, that's hard to say. And I'll get into a lot more detail on what the actual valuations look like within the webinar I'm doing later this week on it. But just suffice it to say that depending on the type of asset that you have, can be significantly more difficult to value for the purposes of needing to have that readily certified value for the Roth conversion. Because remember, these are these are reportable events to the IRS of a taxable nature. So we have to make sure that you actually have some type of verifiable factual value that backs up whatever actually reporting to the IRS. Now, also, let's keep in mind that with a lot of excuse me, with a lot of things going on this year, values for a lot of different asset classes are suppressed. So, especially if you're looking at, if you have a more traditional stock portfolio, doing a conversion now might be a great benefit if you're planning a long-term hold of a lot of these assets. Because remember, it's a specific snapshot in time of whatever the value of that asset is. Now, what I will say is that a lot of real estate investors that we had, especially back in the financial crisis of 2007, 8, 9, did a lot of conversions of real estate around that time because values were so significantly suppressed that they were able to convert at a much lower value. So let's say they had bought a property for 300,000, it was now worth 180. They got to convert at 180, or maybe even strategize and split that bill over 2 years. So they only had to take in 90,000 of income in 2 separate years to convert the entirety of that asset into a Roth IRA. So I think you can really see the benefit of when values fluctuate. And that's why, especially when there's market factors that are causing things to be depressed in value, that doing Roth conversions at these times is when most people elect to do them, because you get to take advantage of those reduced valuations. Now, unfortunately, we're not seeing a huge dip in the price of real estate. So unlike back in 2008, which is definitely a good thing, I don't want to come off and say, there needs to be a huge cataclysmic shift in the valuation of real estate. But I think it's, again, worth saying that depending on what you're looking at, whether that is especially things like cryptocurrency, and that kind of reminds me, that's why I led off with the FTX Binance a letter of intent buyout, is that if you are invested in something like cryptocurrency and you want to be in it for the long haul, looking at doing a Roth conversion now, if you had bought it in a traditional pre-tax plan, could be a very, very beneficial thing for you to do. Now, again, we cannot give you tax or legal advice. You need to absolutely check with a tax preparer or someone that can advise you on your current personal taxable situation to see if it is a viable option for you. But if you did want to have those assets in a Roth IRA and you were unsure of how to do it and you didn't want to sell, but you want to, not necessarily pay more taxes than you otherwise should. I don't think anyone, if I asked for a raise of hands in the digital world, would say, yes, I would like to pay more taxes than I need to. If you're invested in some of those types of assets that are, have a relatively attainable market value, so you don't have to do a lot of research and an expense on getting some valuations done, and also we're seeing significantly depressed values, doing a Roth conversion, again, could pay off in spades for you down the road. Again, make sure you check with a tax or legal advisor on that. But again, if you are invested into some type of asset class that is seeing valuation dips, just understand that it is a very good time to look at potentially doing a Roth conversion. Now, looking at, again, some different other types of alternative assets, it's going to be harder to kind of get a grasp on what exactly a valuation looks like for some of those, especially when it comes to larger commercial real estate. Getting an attorney or someone that is familiar enough that could sign off on a valuation, because you can't just take the valuation update that we would take on an interim basis for a fair market value from like a CFO or someone saying, hey, the value of this is X, the value of this is Y. You need to make sure that you're getting a certified qualified third party to look at it. But one thing I will leave you with on the valuation for Roth conversions is that especially for people invested into private LLCs, there are some additional ways that not only the underlying asset value, but the method in which you do the conversion can also help to further reduce your taxable liability. Now, again, I always have to preface when I say this that I don't want this to be construed as tax or legal advice. When it comes to doing valuations, 100%, I cannot stress this enough. Get the advice of a qualified attorney or a CPA to guide you on this. But in general practice, when you are doing a sale or you're looking at the value of LLC membership or the ownership in a company, if you are looking at a non-controlling interest, that can typically be looked at with a discount, meaning that if you convert something that is not the controlling or whole, controlling interest being 51% of a particular entity, that can be looked at as a less of a value than just whatever 49% of the company would be. Because if you had 51% of a particular entity, then that would also equate to additional value, because there is value in being able to control all of the actions of a particular entity. So if you are invested in, let's say, a checkbook control LLC or a single member LLC, and you wanted to do a conversion, there is potential. And again, you would need to work with your person doing the evaluations to potentially being able to offset or shift taxes even to a greater degree than you would if you owned, let's say, an asset directly, like a piece of real estate, but if you owned it through an LLC. Again, that is a very interesting way to look at things, especially at looking towards the end of the year when you want to maybe split tax liabilities across 2 different years. Looking at the discount valuation models you can use for closely held entities is absolutely something that people should do if it is a viable option for you. So I just like to make sure people don't leave cash on the table when it comes to doing Roth conversions, and that you understand and explore all of your different options. So what does that mean? That means talking to people that are familiar with doing the valuation of whatever particular type of asset you're looking to convert. Again, if you're in a cash position, you don't need to worry about this. Cash is just converted into dollar for dollar value. If you're at some type of cash alternative or readily traded asset value, so things like stocks, precious metals, cryptocurrency, you don't really necessarily need to worry about this, because everything has basically a spot value. If you want to convert X amount of something, it's whatever the spot value is as of the exact time that you're doing it. Easy enough. But with things like real estate, limited partnerships, private stock, these things are much harder to value. And you would need to get some additional third parties involved in order to be able to do a proper valuation, in order to do that conversion from pre to post tax. So just keep in mind that, conversions, while easy enough to wrap your head around why it might be a benefit to you and, particularly your particular investment strategy, the actual procedure and the method for doing it can be significantly more complicated if you are invested into alternative assets. So each one's going to be different. I would always encourage you to reach out to someone like myself that can help and guide you on something like that. I am always happy to help on the different strategies and what exactly needs to be provided in order to do a proper Roth conversion, because it can vary widely from different plan to different asset to different asset, and sometimes different assets even in the same class. Let's call it private stock or closely held securities can also vary widely as well. So you just need to know that there's a lot of differences in these things, just a lot of nuance, and I or someone like myself can certainly help you out with that. So with that said, again, the basics of a Roth conversion are that you're moving from a pre-tax account such as a traditional IRA, SEP IRA, 401k, simple IRA, to an after-tax plan, meaning that instead of paying taxes incrementally when you distribute funds in retirement, you are going to elect to have all the taxes preloaded or prepaid. So that way, when you take distributions in retirement, and then all of those earnings that you've had on any of the assets within that plan are going to be completely tax-free, which, again, let me say that, completely tax-free. I think in anything in life, again, it's not free to get into that situation. But when you can look at basing a retirement plan, especially a large chunk of your assets, and never having to worry about paying taxes in the future, I think that's a very, very powerful tool for people to really kind of examine. And I hope you do examine it closely, especially with the fact that, sometimes with changing legislation, your ability to do Roth conversions, does tend to ebb and wane when it comes to different political ideologies kind of coming after it. So the ability of people to do it now, and especially as readily available as it is to everyone, I always encourage people to take a look at it, because just like with anything in life, it may not always be here, but take a look at it. We can certainly help you with different strategies. Tune in later this week to my webinar where I'll be going into much more detail on the technical aspects of this. and some different types of plans and options, especially with doing conversions and things like 401ks and other type of business retirement plans. So again, this has been the Alternative Investing Advantage podcast. My name is Alex Perny. I hope everyone has a great week, and we will see you on the next one.
Thank you for tuning in to the Alternative Investing Advantage podcast. Tune in next week for more investing tips and strategies.
Want to hear more episodes of the Alternative Investing Advantage? Search podcast at advantaira.com and subscribe.